trust but verify. When somebody tells you about their track record, don't just look at an Excel spreadsheet and say, okay, that looks good. Go get the tax returns, go get the receipts.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show, this time with Steven Libman. Steven, thanks for coming on.
Hey, thanks for having me. Appreciate you taking the time and getting a chat together.
Yeah, for sure. So, Steven, want to walk the listeners through some of your background?
Yeah, so, we didn't come from an institutional background like many. We actually came from the single family world space. And I started as a realtor about 20 years ago and was a real estate broker through the downturn and was sourcing good off-market bank-owned properties for investors that were buying and flipping property. And after working for a couple of years in that space, I realized that I still didn't actually work for myself and thought that what they were doing wasn't rocket science and maybe I could do it too. So we started wholesaling property back in 2011. We grew to a pretty well scaled out flipping business, did about 1,000 flips in New Jersey. And we were just getting creamed in taxes. And one of my buddies said, you should buy an apartment building because you'll pay significantly less in taxes. And of course I didn't believe him. So I nerded out and read the tax code and it turns out he was right. Commercial real estate does have some pretty good depreciation benefits and some other long-term tax benefits and things like that. So we decided to pivot into the commercial space. We built 3 self-storage facilities out in Orlando, Florida with a great partner to get our feet wet. It's about 300,000 square feet of self-storage, branded it CubeSmart and exited those properties. And then we started getting into the multifamily space. And since 2018, we've acquired about $560 million worth of property. Currently have just under 3,000 doors under management. And it's been an incredible journey, learned a lot, continue to build and scale the team. And we are still doing massive acquisitions. We've closed about $242 million worth of property in the last 60 days and have another closing in the next 30 days for another $40 million worth of property. So there's opportunity out there for sure.
Yeah, so walk us through the flip business, right? Because that's a business that, I come from a sales background, right? And I feel like all the people I know who have companies that flip, they've got really big wholesaling teams, right? Really big sales force. Kind of walk me through what that looked like for you.
Yeah. So, first of all, it's a grind, finding deals, acquiring deals. You needed a pretty big team. We were spending $50,000, $60,000 a month in marketing and mailers, the We Buy Houses, note cards and whatnot. We didn't start there. Obviously we started with, MLS, trying to hunt down deals, do onesie twosie, put it under contract, sell it to an end user who was going to do the flip, and that's the wholesale business. And then the flip business was a machine. We were acquiring, 10 to 20 properties a month, and then managing all of those rehabs and flips. And it was a bear.
And when you made the transition going into the self-storage world, what did that look like for you? Because in the flip business, did you guys take on private capital, or was it all your own money you were recycling? What did that look like in terms of how you actually funded the flips to keep things going?
Yeah, so we started with hard money, and then we started to run out of the gap funding that you'd need to put down on the property to get the hard money. So we started raising that capital, and then we started realizing, private investors were willing to take down the entire note, in a first lien position versus just a small piece of it. So we started raising a couple $1 million just for the flip business. And that's exactly right. We started going and meeting with investors and seeing that people had an appetite to do some real estate investing for a solid rate of return. And when we made the transition to go to self-storage, it was an easy sell, right? Because we were, doing 8-10% mortgages in first lien position, and it was 1099 to the investor. And then we moved into the self-storage space, and Now you became a K1 investor. You got depreciation. You got other tax benefits as well. So it wasn't a very hard sell for us raising capital for single family to move into commercial. It was much more passive. They'd get longer term returns. They'd get long term capital gains instead of 1099 income. So it was a benefit to them and it was a benefit to us.
Yeah, the big thing that Steven's mentioning here too is the 1099 income is taxed as interest, right? So if you're in the make 10%, your 30% tax bracket, you're only taking home 7. Whereas if you're investing into, say, a self-storage, multifamily, more commercial type project, you're getting a level of depreciation as well in that year 1, right? Sometimes year 2 or 3 as well, that will allow you to go help wipe out that cash flow for the first handful of years as well. So making the pivot into the storage world, right? What did it look like for you guys to get started in terms of actually going out, finding projects, developing them, etc.?
Well, it was like, how do you get into this space? Right. And I feel like that's always the first question a lot of people ask us is like, well, how do you go? And, I had a lady call me yesterday and she was like, hey, I'm negotiating this deal uh, with this realtor. It's a 300 unit. And, she's never done a deal before. And the question I asked was, what makes you think that they would give you the deal? Because when we started doing research to get into the commercial space, we knew that one, we wanted to be in the commercial space, but I think it was, well, we don't have the experience to talk to the realtor. We don't have the experience in terms of getting the debt. And some of the hurdles that you experience when getting into this space is you have to have the net worth to sign on the debt. You have to have the experience for a realtor to give you the deal so that they know you can execute on the deal. So what we did was just start looking around for partners. We literally took it to social media and just said, hey, we're looking to deploy a couple $1 million in capital into a particular commercial deal. If you know anybody that's looking for capital, let us know. And we knew that arguably we could bring $2 to $4 million to the table based on our network. And we just figured partnering with an experienced operator and learning from the inside out would be the fastest way to success. And, we did one deal, it was 1,183 units. And then, it was a $14 million project. We had to raise about $5 million for it. And we were able to do that, executed on it. And then deals number 2 and 3 came in the same year right behind it. And now all of a sudden we were co-GPs into, nearly $60 million worth of property. And, it took about 6 months to find that right partner, that initial right partner that one aligned with our core values and two had the experience that we were comfortable with, knowing that we were going to be putting our capital and our investors' capital into those deals, making sure that they had the track record. So once we did that, it was like, okay, we're off to the races. And then we started doing some of our own deal flow, which was smaller class C minus maybe type properties. A 66 unit that was 3 million that now we had the net worth to be able to sign on the loan for, and we had the experience. So that's kind of, that was the genesis from going from single family flips to how do we go out and find the right partner? How do we deploy capital into the right deal? And then just start getting our own track record that was viable to go show other brokers and bankers.
Sure. So I think that's a really important part, right? Because if you look at people in this space, they tend to go 2 routes, right? One being the operator, right? Buying, finding, managing their deals. And 2 being more the capital partner in which they're allocating capital, being co-GP, a fund to fund into someone else's project. On the latter side, right? What was your process like to go see, does this person align with everything that we want to go do? Because if you're a capital allocator, that's the single biggest decision you can go make is who do you allocate that capital to and partner with? Because in turn, their success is your success, their failure is your failure, their lack of communications on you, right? So how do you, what was that process like for you to go really ensure that this person, this group was someone that you felt confident with?
Yeah. So it starts with track record. Somebody reached out to us and his name is Sean, who's our first partner. And he said, hey, I have this deal. I saw you guys were looking to maybe deploy some capital. Let's jump on a call. He explained the deal to us. We liked it at a high level. We looked at, some of the underwriting, some of the pro formas, some of the, what do you call those? Feasibility studies. When you do self-storage, they do feasibility studies. And so that was like step one. Okay, we at a high level like the deal. Two, what's your track record look like? How long have you been in the business? How many deals have you done? How many exits have you had? Et cetera, et cetera. And going through and vetting that process out was kind of step two. And, all that sounded good. And then it was, all right, let's fly down, meet with the operator, meet with his family, meet with his wife, his kids. Like, let's just see if we're the same people, and people that you could go out and have a drink with, somebody that you could go out and have dinner with. Um, and then just talk about kind of what's important to you and your family. Like, why are you doing what you're doing? Are we just doing this for money? Or are we just doing this to get a track record? Like, what's the purpose behind all of it? And, I think partnerships, and we've been burnt by plenty. Partnerships are the most difficult thing, I think, to really learn how to vet out. And what I tell people now is, if you and your, like, I have a business partner, but if you're a single entrepreneur, or if you have a partner, you by yourself or you with them need to sit down and kind of write down your core values of, as a business. What are the core values that are what we call non-negotiables, right? What we would hire, fire, promote, and demote on in terms of a company. And when you identify your core values, then it's very easy to sit with a partner and say, hey, just so you guys know, like, this is our core values. And a violation of one of these would be catastrophic for our relationship. So let's talk through them. And then vice versa. Like, do you have a set of core values that you guys live by? And let's talk about those. And let's see, have you ever violated them? Have somebody else ever violated them? What did that look like? How did it go? Right. And I think the best thing that you could do when starting a new partnership is, one, be extremely vulnerable, and two, ask extremely poignant questions to that operator. Because you're about to get married, right? These deals are not small. These deals are not short. These deals are not a single family flip that takes 62 days. I mean, these are 3 to 5 year commitments, and you need to know up front kind of who you're dealing with. And we've had some past indiscretions based on kind of just the wool getting pulled over our eyes and being told what we wanted to hear, and didn't spend enough time walking slowly through that hallway to really learn who they were. I think the best thing that you can do is go make sure if somebody's married with a family, like, go have dinner at their house. Go make sure your wife is meeting their wife. Like, those types of personal relationship type things that are going to carry you through when things go wrong, because it's not a matter of if, but when. And then how do you deal with problems when they arise?
Sure. So walk us through one of the partnerships on your end that didn't go as planned. What were the things that led it to go be that way, and how did you handle them? Because I think right now there may be a lot of listeners who partnered on deals that aren't going as they planned with the operating partners they've chosen to go work with. Right? We see a lot of new people get into the space in the last few years, and you saw values go up, values go down, values, going back and forth now as well, right? So there are people who are in partnerships that may not be ideal, right? Want to walk us through a scenario in which that happened to you, and really how you handled it to come out as unscathed as possible for both you and your investors in that scenario?
Yeah. So in the past, we've had a partnership that we created where we traded off some equity for a property manager partner, and they were going to do all the operations. We were going to continue to do the capital and investor relations side. And what happened was the breadth of experience that was touted to us wasn't necessarily their own. It was at companies that they had previously, right? So if they were an asset manager or a property manager with a large REIT or a large bank, then they didn't manage 20,000 units, but the company that they worked for did. And just how that was presented wasn't as authentic as we would have liked. And then when you got into the nitty gritty, it was like, man, we're not seeing what you're telling us we should be seeing, right? It's like, oh, we're going to have these reports to you by Friday. They didn't come until 2 weeks later. And we're a big believer of letting your yes be yes and your no be no, and just being authentic and transparent about when problems happen, and that communication. And communication broke down. The assets suffered because of it. Right? Occupancy was going down. CapEx was taking too long and was too expensive. And there was just a certain point in time where we recognized like this isn't going to work. Um, so how do you rectify that? I wasn't ready to sell the asset. We've actually not made the asset better yet. It's been 14 months. And this is years ago, by the way, and we don't own this asset anymore. So if you're an investor of ours and listening, this is not one of the current issues that we are experiencing. But it was a great learning curve because we went back to that partner and we said, look, we've lost confidence. Um, I don't think you're able and capable to do what you said you were able to do. And they said, okay, well, what do you want us to do? And so we could buy you out or we could sell the property for a loss. And they said, okay, well, and then, it's so funny because you have these partnerships that they think they're doing a great job. So they're trying now to get the buyout on the future appraised value of what a stabilized asset would look like versus the equity that they got coming into the deal without having to put any cash in, just sweat equity. And so anyway, that was an interesting negotiation back and forth. And we took it on the chin a little bit where at the end of the day, it was worth it to pay them more to get them out of the deal than it was to pay them what was fair to keep them in. And we were able to turn that asset around. We took the profit margin hit off of our end and didn't affect the LP investors. But what that made us recognize, and this is going to sound really simple and really elementary, but trust but verify. Like when somebody tells you about their track record, don't just look at an Excel spreadsheet and say, okay, that looks good. Go get the tax returns, go get the receipts. It's important, especially in this game. Like it's easy to say, and people do it all the time, right? Capital raisers and other people, allocators, they will be a limited partner on a deal or throw $100,000 in a deal and say that they owned a 282 unit. And right, we see it all the time. And, to the extent that that's true, it's also to the extent that they own a very small percentage of that. So, when you start talking about track record and exits and IRRs, it's important to know where those numbers could get flubbed a little bit and to make sure that you're really verifying what that track record truly looks like. That was the biggest takeaway from us. And so we're a Christian owned and operated company. My partner and I are believers. And I think partially the problem with that was the relationship came from a faith-based perspective, and they kind of touted that too. And maybe it let our guard down a little bit. And that was a learning curve for us too. I think, people should understand that you're faith-based based on the excellence in which you operate, not because you say it. Right. And that shouldn't let your guard down. In fact, it should make you be able to trust and verify and see more transparency and accountability than otherwise would be expected.
Yeah, and you make a really good point. It's funny. I think you're probably one of the more experienced people I see actually active on Facebook, right? I'm on there as well. And on Facebook, you see a lot of stuff that just is tough to go through, right? There's definitely some gold in there in terms of people, in terms of deal pipeline, in terms of nuggets of information. But in turn, there's also a lot of stuff on there that is a complete waste of time. And it's funny you mentioned the folks who are the AUM unit count pushers when their ownership equity involvement is super low, right? Like even speak of myself, right? My role's primarily been on the equity fund to fund, right? Key principal, working a loan guarantor side of the house as well. And you're we invest in probably $2 billion plus in assets, but that would never be something like we actually mentioned because it's your ownership is much smaller in actuality in those deals, right? So I think it's understanding what people have actually done, their involvement, their ownership in those projects, and where they've been involved. Like there's value in picking good LP deals, there's value in picking good operators, but as long as it needs to be clear to those people that are investing with you what your involvement was. So you make a really good point there too.
Sure. Yep.
And kind of shifting gears to, I know you mentioned kind of before, we were talking before this, is the integrity-based investing, right? The impact fund that you guys run. Can you walk me through what that looks like and kind of what it means to you as well?
Yeah. So, we were generosity has always been in my heart in this business. And I was trying to figure out how we could give more abundantly before we quote unquote made it. My wife asked me to pray for the grace of growing in giving because, if there was a need, I wanted to fulfill it, whether our bank account could sustain it or not. And, so we were trying to figure out like, how do we consistently start to give and be more abundant before we, have $1 billion under management. And, so what we did was we started to carve out, we're a tithing company, which means the first 10% of our profits goes to nonprofits. And then after that, we gave 1% past the tithe to a nonprofit in our first deal. And it didn't relate to a lot of money, but the next deal, we gave 2% of our corporate profits. And then the next, it was 4%, and then 6%. And this year, we're targeting hopefully 13%, depending on profitability, past our 10% tithe. And that now goes to a donor advised fund that has funded, over 35 different nonprofits over the last couple of years and affected hundreds of thousands of lives doing a variety of things. One is, we've dug wells in Africa. We're working with the Tebow Foundation, saving girls from sex trafficking, just working with different cultural leaders and community leaders and all kinds of various nonprofit arenas, which has been extremely gratifying to us. And we make that part of our customer reports, our monthly updates where we're giving corporate entity reports and then property reports and then also nonprofit reports as to what we're able to do through the business. And it does so without affecting our investor returns. And then secondarily from that, we work with a nonprofit called Apartment Life. Apartment Life, we give free apartments to their nonprofit, which they staff with on-site cares teams. And they run biweekly events at all of our complexes where they're doing movies under the stars for kids. They're doing barbecues for the community. And every other week, they do some kind of event, whether we're dropping off Netflix coupons with a bag of popcorn or we're inviting them for coffee and donuts. And what that's doing is really helping create this culture of community. So they're serving the tenants, they're serving the property managers and asset managers that are on site as well, and just really trying to create a better tenant experience. And finally, the third thing that we're doing now is every time we purchase a complex, we'll partner with a local church that's interested in adopting the complex. And what they're doing is creating a multifamily ministry, essentially, that comes and serves the complex, and in different various ways. I mean, we've heard stories of other people that have these programs that are implemented where mechanics are coming on the weekends to do oil changes and tire rotations for single moms that are on site. We're dropping off diapers and wipes to new moms that come home with babies in the complex. So there's just a variety of things that you can do in these complexes to just create a better tenant experience. And what that does, ironically or non-ironically, is, we're able to do some good, but also do well by doing good. Our lease attrition has dropped by nearly 35% portfolio wide when we implement these programs, because people aren't leaving, because now they know their neighbors, now they have a community and a connection. And lease turnover has significantly dropped there, which increases IRR, as you know. So it creates a better investment vehicle, but also better Google reviews, better tenant experience, things like that. So, next summer, we're going to start implementing this program through the churches, that part of our donor advised fund will fund the local church so that they can give free tutors to the complexes for kids. Because I don't know if you know this or not, Sam, but kids that live in multifamily housing typically fall further behind than their single family counterparts during the summertime. So we're able to provide free tutors for them so that they don't fall as far behind during the summer. So there's all these little programs that we can kind of create and implement that can really start to change the trajectory of people's lives. We just bought 420 units in Texas 2 weeks ago, and it was 210 duplexes that we packaged together and bought as a 420 unit complex. And over the next 3 to 5 years, we'll implement those 3 programs that we just talked about, but also we're adding on a financial education component to that, so that the tenants that live there can decrease their debt, increase their credit score, and work with a local credit union that we're talking to get a 3.5% down Fannie Mae multifamily mortgage, where they can move from being the tenant to actually being the landlord. And uh, the average homeowner in the United States, their net worth is somewhere in the vicinity of $400,000. The average net worth of a tenant is $10,800. Right. So we're helping people move and kind of move from that tenant to landlord gap and replace that wealth gap.
Yeah, no, that's really cool that you're doing all that. I think most people aren't thinking about it that deeply, whether they don't care enough to, whether they don't want to be as involved. But I think it's really cool in terms of how you can also give back quite a bit, but actually still really impact your investors in a positive way in doing so in terms of the metrics, deliverables behind it. But I can definitely see the sense of community being created there. And you look at turnover in multi, it's not small. So that shift,
Yeah.
I think, is a really big piece of it for helping those people as well. Um, but yeah, no, just really cool that you're that invested into doing that and doing a lot of good as well. So kind of shifting gears more to the deal side of it too. I know we were talking before about a recent deal in Tampa that was a really cool structure. So before we hop here, I'd love to dive into that deal as well in terms of how you found it, how you bought it, the structure that you used for, and kind of how you raised the capital for it as well.
Yeah. Well, so interestingly, we bought it in 2022, but it was a 257 or $258 million acquisition. And we just liked the operator, institutional grade operator, 2 billion plus under management. We wanted to partner with them. It was the end of the year. We had some dry powder laying around, and we just deployed like $2 million into it. Now, a New York City REIT brought the other 50 plus million into the deal for closing, about $198 million loan on it. So we just came in as an LP. The fund came in as an LP, and the metrics were good. And 2 years later, right? Fast forward 2 years later, we have to refinance this property because it was a floating bridge loan. Well, as you know, interest rates have doubled in the last 2 years, tripled in the last 3 years. And now we're looking at, looking down the barrel of this refinance. And what's going to happen? The bank wants us to buy the debt down more. So they required a $10 million debt pay down on that project. And so our piece of that was going to be, I don't know, a couple $100,000, right? Not a lot of money. The New York REIT was going to be required to bring 10 million bucks. And they are mostly in the single family mortgage space. So multi-billion-dollar REIT, very small amount in the commercial JV equity space. So they made the decision to write down their equity and just take it as a loss. And so they just said, just give the property back to the bank, we're out. And us and our partner were like, well, we still like the deal, right? We like where it is. We like the gentrification of it. We still believe that it could be a good project. Let us make you an offer and we'll buy your position out and hold you harmless to it. And they said, okay. So they have $57 million on the table. And I'm going, what is a fair offer, right? Like, what do you make an offer? And our partner called his buddy at YPO, who's been in the business for 50 years. And he's been doing commercial real estate for a long time. He said, hey, I had this exact thing happen to me in the 80s. I think you should go back to the REIT and offer him $100. And we thought he was joking. And but we did. We went back to the REIT and we offered them $100 to purchase out their $57 million position. And the thought process is they already wrote it off, right? So everything that they get back now is just gain to them. And so they went back and forth. Their counter offer, by the way, their initial counter offer was $1 million. And we knew we had a huge opportunity in front of us because if we would have paid the million, we would have paid $1 million. Long story short, we ended up paying $50,000 to purchase out their position. We had to bring the additional $10 million to purchase the loan down. But in a period of 22 months, we reduced the basis by nearly 30% of what the original purchase price was. So now, even if we just get the property back to stabilization and stabilized value at acquisition, we've we've killed it. So, that was a just huge opportunity. As well as anybody else, we call those unicorns in the business. They don't happen often, but it went from a deal that was suck and win that needed to get a refinance done to a deal that, could end up being a career deal because it's just such a large complex, 60 acres, 982 units. Really cool too. It's actually separately deeded into 3 different complexes. So we don't need to find a $300 million buyer when we go to exit this property. We can separate them out into separately deeded units to where, somebody taking down 350 units, much easier to find than somebody taking down nearly 1,000 units.
Yeah, really cool in structure. I think there's a lot of room, or there's going to be a lot of room still now for creativity and structuring of deals with where things are going, right? In terms of making sure people aren't giving keys back, right? Rooting that, black mark with Fannie or Freddie on future loans, right? So definitely see opportunity there. Before we hop off here, kind of what advice do you have to someone looking to get started or scale up in the space right now?
Yeah. So one, I think you have to understand underwriting. I think everybody talks about conservative underwriting, and, I think that right now, especially, yield on cost is important. Exit cap rates are going to be important, how you're underwriting those. I unfortunately know a couple operators who have purchased some deals in the last 12 to 24 months where they were banking on these rate cuts. And the only way that the deals work is if they were getting the 6 rate cuts that they initially started talking about in January. And now we're down to maybe a rate cut by the end of the year. So, just be smart. Don't bank on rate cuts, right? Bank on today's cash flow bank on still exiting at a higher cap rate than you're entering for. If the market shifts and that doesn't happen, fantastic, right? You'll do better. If you're getting started in the space, I think the best thing that you could do is find mentors, find people that are doing it, get around them, see what kind of value you can add to a property like that. There's a ton of actually very cost-effective fund-to-fund structures now that you can incorporate into getting started and being a part of these deals. Number one, write down your core values, right? Write down your core values, understand what they are so that when you go and meet with people, you can have that conversation about, is there alignment of interest? If you don't know how to figure out what your core values are, very simply, take 3 people that you admire in your life, whether it's a superhero, whether it's a historical figure, or if it's somebody directly in your life. Write down the 3 to 5 traits that you admire about them, and over the 3 people, you'll probably see some overlap, right? And that overlap tends to be the stuff that you value the most, so you'll see them as your core values. And then go find those people to partner with. This is a team sport. Very few people, I think, have had the level of acquisition success that we have by themselves, if anybody. So, find the people, find your tribe that you can resonate with, find some mentors that can guide you through it, find a coaching program that can give you at least a baseline understanding of what it is that you're going to do. And then in terms of scaling, I think the riches are in the niches, right? We tried to be all things to all people when we first started raising capital, and you get lost in the noise, right? And now that we've really landed on the purposeful investing piece, I find that there's more resonance with our investors. Of course, it's a smaller subset of investors, but it's the people that really care about what we care about. I think as salespeople, sometimes we want to be all things to all people, but that's not how you differentiate yourself in a very loud market. So I think understanding who you are and who your target audience is going to be huge for you to be able to scale up quickly.
Sure. No, that makes a lot of sense. And what's the best way for people to reach out to you?
Yeah, you can go to our website, investingwithpurpose.org. We also have a podcast called Investing with Purpose, and we just released the Investing with Purpose book. So any of those ways you can find us. We're on LinkedIn, Steven Libman, and every social channel that you can imagine.
Cool. Steven, thanks for coming on.
Sam, appreciate it, man. Have a great day.
Thank you for tuning into the Fully Funded Show hosted by Sam Silverman. If you are enjoying the content, let's take your journey further in the Fully Funded Mastermind. The Fully Funded Mastermind offers more than just insights. It's a mastermind community designed to solve the real challenge of raising capital. By joining, you gain direct access to strategies, coaching, and a network dedicated to turning your financial goals into achievements. Don't let capital raising be a barrier to your success. Visit fullyfunded.capital to explore how our mastermind community can pave your way to financial growth.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow, share with your investing pals, and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.